Good morning or good afternoon, depending on where you are. Thank you for joining us today. Dean, if you want to move to the next slide.
Yeah, I'd like to. There we go. Okay, sorry.
So I'm Maria Fernandez Vidal. I lead CGAP's work on data, where we look at the role that sharing and using data can play in advancing financial inclusion. And Dean, go ahead if you want to introduce yourself.
Yeah, sure. Hi, and I'm Dean Carey. So I'm a credit scoring expert or consultant. I work mainly with the International Finance Corporation and their clients, and also with others, and work with CGAP on some of the data work it does with partners, and particularly when there's credit scoring involved.
We can go to the next slide.
Mm-hmm.
So our agenda for today, we've divided this workshop in two parts. So the first part will walk you through general and intentional techniques and strategies that you can apply in credit scoring, and we'll have a Q&A. And then we'll move on to a second part that's more applied, where we'll cover kind of the same content, but instead of just explaining the analysis, we'll actually show how to do the analysis in Excel, R, and Python. So if you're not looking to implement those analyses, that second part may not be relevant for you. Feel free to drop off if that's the case, but otherwise, everything we cover in part one, in part two, will show you how to actually do this. And we'll have a Q&A at the end of each part, but feel free to put your questions as we go along in the chat, and I'll be monitoring the chat and either answer there or bring your question back to the live discussion, but you can do that at any point. So I'll just start with some of the main messages that we want to share with you today. The reason we did this work is because from our experience, we see that women tend to have, on average, better loan repayment rates than men. So that means that in a way they're being subjected to a higher bar when they go through the credit process. And the women that do get approved tend to be lower risk on average than the men that get approved. So when this is the case, a gender disaggregated data analysis can find ways to improve conditions for women, either increase credit, lower the cost, increase the participation, and that can be done without increasing provider risk, because it's basically a way to better measure the risk, and it can be beneficial both for women that can receive more loans, as well as for providers that have the risk more accurately priced in their portfolio. And so we start with a gender analysis. They can first just see what are the gender gaps, what does this look like in your portfolio, and then we look at how applying different strategies based on those results can lead to different decisions in terms of how many loans go to women, how many loans go to men. And we show that for a given, say, level of risk that you want in a portfolio, a gender intentional strategy can lead to just a larger portfolio, as well as a bigger percentage of that portfolio going to women. So again, it's something that both benefits women and providers in this case. So that's why we're interested in showcasing this. We see kind of a win-win situation there when the conditions are that we find this case that women are showing lower risk than men. So I'll turn it over to Dean now.
Mm-hmm. Okay, thanks, Maria. Yeah, and just on that first point that Maria raised, so it's interesting because, as I've mentioned, I'm doing credit scoring and for many years, which I didn't mention, but so for over 20 years, I've been working with different financial institutions and in 60 countries, like hundreds now of scorecards and different financial service providers. But almost all the times, the great majority of the times when we do have data on gender, women tend to be better repayers. So that's just like one of the global things that you see in data sets, just like you see that borrower repayment improves as people get older. So that's like a kind of a universal relationship you see in most data sets. And you also do find it, or I've found in all these credit scoring data sets I work with, that women are lower risk. And that's just important to what we're going to present, because while many of the lenders may be aware of that in one way or another, this type of analysis we're going to present is not particularly difficult, and in some ways it's quite simple, but it's not something that people are routinely doing in terms of looking at their scoring models. So I think it can be useful, given the fact that in so many financial institutions, women do repay better than men, and that creates the conditions where you can have the win-win that Maria is talking about, where you can both increase credit to women, which, you know, and just increase credit overall, which increases business, but you do that without changing the risk of your portfolio generally. So what the crux of this first part, gender lens analysis, is just that we're going to look at how lending outcomes differ for men and women, to see if there's an opportunity to serve women better. And of course, if there's not an opportunity to serve women better, or even if, you know, or if there is, it doesn't mean you have to apply these strategies. But the first thing that everyone can do, you know, even after the webinar today, because hopefully it will seem that easy after we go through it, but you could just look at what is the situation in your own organization for those of you using credit scoring on the one hand for the strategies, but this first part I'd like to show actually doesn't presuppose the use of any credit scoring model. So just to do your basic gender lens analysis, you need really very little data. What you need is a table of data. So it could be for your entire portfolio, but a lot of times it will be, you know, you might want to look at this based on loan products or different types of segmentations. But the data you'll want to look at is a table of loan level data. So where each row would be like a loan application. And the other data you'll need is you'll need the applicant's gender, so male or female. And then you'll need the outcome of the decision, which was to accept or reject the application. And then for all the applications that were accepted, you'll want the outcome of the loan, where the outcome for the purpose of credit scoring analysis will be classified into being a good or bad loan, where good means a loan that repaid on time and in full usually, and bad can be defined in different ways, but it would be some level of delinquency. And when you have just those essentially 4 columns of data, you know, for each of your loan applications in a portfolio, you can understand what share of your applicants are women and men, and what's your approval rate by gender. And then you can also look at your issued loans, so you understand what part of your portfolio is going to men and women. But particularly for the application of these gender intentional strategies we'll look at for credit scoring, you'll see the delinquency rate by women and by men. And then normally, as in this example here, so if we look at table 4, which is one of the examples used in the guide, you see that women have a bad rate or a delinquency rate of 5%, so 5 in every 100 borrowers, whereas men are twice as risky in this particular example, so 10 in 100, and the average is 7%. So that's an example of one set of conditions where we'll be able to look at some possible uses of gender intentional scoring strategies. So what you get from gender lens analysis then, so you've done that table, right? But this is just a way I like to illustrate that if all you know, if all you knew was your delinquency rate, which was 7% on average, without the gender lens, you know that if you continue lending according to your policies that you've been using, you know, so whatever your minimum lending criteria and then your underwriting standards, and when someone meets all of those standards, you issue the loan. But you know from your past experience that for 100 loans, 7 of the borrowers are likely to go into delinquency or go bad, because that's been your experience in the past. And as these new 100 applicants come in, you don't know which 7 that will be. You just know on average 7 people who meet your criteria out of 100 will be late, right? So if gender is the only characteristic you look at, and you divide your data up, knowing, as we just saw, if we look at the panels in figure on the right-hand side there, figure 2, we know that when 100 women come in, it's only going to be 5 of them that we expect to be late. And when 100 men come in, it will be 10, right? So we've established that men are twice as risky, but also we know that 60% of our borrowers on average are women. And so for every 100 borrowers that come through the door, we expect 60 to be women with a lower risk of 3 out of those 60, we'd expect to be delinquent. And for men, that 40 of the 100 borrowers would be men, and 4 of them, or 10%, would be delinquent. And so if that was the only analysis and we stopped right there and we don't have any other tools, we could generally say as a strategy that if we increase lending to women, if that was possible in one of any number of ways, that we would be able most likely to increase the portfolio then and still not increase risk, because women are quite a lot lower risk than men in this example. And so that would bring down total risk. Obviously, if you were, well, anyways, without going further than that, so you would be able to say, well, we could increase lending to women, but it's not really a strategy that can be articulated in any concrete way or analyzed, because it's general, and it would require actually changing some things to what you'd been doing before, and so therefore its outcome wouldn't be known. But that's outside of having any tools. If you've done this analysis, you'd know, well, look, there appears to be the opportunity to serve more women. But what you do to take the next step, and as I think many of you are using some kind of credit scoring model, when you have a credit scoring model, you're able to rank all your applicants, men and women, based on their overall risk of being or chance of being a bad loan. So you see who are your very best or lowest risk customers and your very highest risk ones, and then you can apply strategies based on your expectations of how that strategy will affect your bad rates. So credit scoring is a way to make quantifiable, explicit adjustments to credit policy or lending policy in a way that's easy to consistently implement through the organization. And before I talk, Marie, you want to jump in here at all before I go into credit scoring? Just
no, go ahead.
Okay, great. So now, for those of you who already use credit scoring, this will all be clear, but I do like to, as I said, up till this point, to do that gender lens analysis, you don't need to have credit scoring, but if you want to apply the strategies, you would need a scoring model or a similar model that segmented borrowers by risk so that you could apply a strategy. One thing I forgot to say on the previous slides, though, about the gender lens analysis is we see what the situation is, right? But as you may be thinking as you watched it, that we don't know the reason necessarily why women repay better by doing that analysis, right? We don't know the why about it. We just know what it is, and the same as when we look at our scoring model, we'll know what the situation is. But if you actually want to know the reasons why you have more women applicants, or women repay better, or more loans are dispersed to women, you would have to do deeper analysis that takes in all the context around what goes into those decisions in order to understand that. This is just telling you what are the outcomes of lending, and then also in terms of your scoring model, what are the outcomes? Okay, sorry. So now, in terms of credit scoring, this is what I like to, as I said, I do this all the time as consulting. So I like to present this timeline. So you see that credit scoring, traditional credit scoring models are quite simple. On the one hand, you take, in the past, you take a set of data of past borrower characteristics and their loans and the repayments. So you just analyze, like, say, 2 or 3 years of data, if you have it, what characteristics the borrowers had and how they repaid, and all the loans are classified as good or bad. So you're studying those relationships, and from those you build this model that results in a score. And you see that when people score 500, for example, that 5 out of 100 of them are going to be delinquent, and when they score 600, which is a higher score, then maybe 3 out of 100 are going to be delinquent. When they have a lower score, 400, then 10 out of 100 will be delinquent. So it helps you to rank them on risk. And when a borrower comes in the present, you score them, and then you attribute that past estimate of risk to the future. So you're just saying, well, when someone scored 500 in the past, 5 out of 100 are risky, and so that's what we're going to predict in the future. And the fundamental analytical tool you use to build credit scorecards and that we already we'll look at in the analysis tables as well. But it's the main kind of analytical tool for traditional credit scorecards is a cross tabulation, or is what is like a pivot table in Excel. But where you're evaluating loan status being good or bad, right? So here, as we've written on the slide, let's say that bad loan is a statutory type definition at the moment, like 90 days in consecutive arrears is usually a definition that requires you to then classify a loan as substandard for official reasons, right? So that can always be it's most certainly going to be a bad loan for most portfolios, but for application scoring, your bad loan definition can be anything, and it can usually be something much less severe than that, because what you want to do is you want to tell apart your borrowers who pay you on time and are generally then profitable, and the ones who repay you with some level of delinquency that in retrospect you probably wouldn't have want to give them the loan. So that's what you want to predict, is that's your bad loan, and you want to see what's the chance of that happening in your model. And so looking at these cross tables allows you, it's really just per characteristic. As I said, you have past borrower characteristics and repayment. Per characteristic, you look at the number of good loans and number of bad loans you gave to people with that characteristic. And then you divide the number of bad loans by the total loans for that group. So if we look at this cross tabulation, we see that in this example, which is based on the data from Time Bank that was shared with us for the study, and we'll talk more about that as we go along. But we see that they made 10,000 loans to women, of which 9,589 were good and 658 were bad, and that was a bad rate of 6.4%. And we also see that the 10,000 loans as a percentage of the total, which is in the far column, was 67%. So they have a large majority of female borrowers with a bad rate of 6.4. And for men, we see that there were not quite 5,000 loans and 396 of them were bad, and that's a bad rate of 8.1%. So much like our earlier hypothetical example, we have an average bad rate there of 7% for this particular portfolio, but women are lower risk. They're slightly below that average, but they're a bigger share of the population. And then men are about 2 percentage points higher. So if there were, basically 6 out of 100 women, we'd expect to repay late, and 8 out of 100 men. And so again, it's that situation where there are women repaying better, so there could be an opportunity to use some gender intentional strategies. But the slide I wanted to show once more, so what credit scoring does, that's one characteristic, right? Looking at gender, and you could put that in a scorecard or not, depending on a lot of things. But in this simple example, what we would do that analysis, that same timeline, and we would turn, and this is a different example, by the way, but you can just see there's bad rates, and we turn those bad rates into points. And that's what those points add together for different characteristics to give us our credit score. So in this simple example, we have just gender, age, and years in business. And we see some examples of points, but when the borrower in the present there comes in, we just look up on our previous analysis. Yes, for a female, she'll get 10 points, 7 points for being in the age band of 36 to 50. And then for being in business between 7 and 12 years, 18 points. And the total score on this very simple scorecard will be 36. And we'll have a table where we've added up our scores. And we know usually these will be banded into some groups like this, sometimes with a stoplight analogy like you see here, green, yellow, red. But in the low risk group, where scores are between 33 and 45, we know that there was 2.1% of those loans were bad in the past. So essentially, we know that if a borrower comes in looking like this lady, that our past experience is 2 out of 100 borrowers with her profile will be delinquent. Whereas, not shown here, if a 18-year-old guy comes in with 1 year of experience, he'll score 10 points on this simple model, and we'll know that basically 18 out of 100, but so something like 1 in 5 of those borrowers will be delinquent. And so we'll treat those differently, whether or not we accept, reject them, or do different things. But that's what the scoring model gives us. It gives us this score that then, and the score is actually a representation of a comprehensive risk profile of the borrowers. And so that score will tell us who's most likely to repay, who's least likely, and that's how the lender can tailor strategies to a risk appetite. And when I say risk appetite, if I go to this next slide, So here's an example. This is also from the guide, and this has small numbers, I'll point out. But so this is just some scores for women, but now we have, it's the same cross table flipped on its side, more or less. We have score bands that range from 0 to 100. So let's say it's standardized. By the way, the numeric scale of the points never matters, really. It's just the ranking. So it's 0 to 100, and we have the good loans in column B counted, the bad loans in column C, the bad rate in column D. And so for all scoring models, when you look at the bad rate in column D and you see scores go from high to low, you should always see the bad rate for a scorecard that works. The bad rate will be rising monotonically with no reversals as you go from high score to low score. So here it's going 0, 2, 2, 3, 3, 5, all the way up to 21% bad rate at the bottom. And the two, when it's presented like this, as can be called the gains table or policy table, but column F and G show us what's the cumulative bad rate at any particular cutoff score we might want to set. So if we look at the green arrow, and the cumulative bad rate is like what you can call your risk appetite. So it means that if at the green arrow, if I approved, based on this analysis, all the women who scored above 40 points, 41 and above, so all the previous or all the higher scores, then that I would expect 3% of that total population to be delinquent, and that would be 68% of my past borrowers. So this doesn't just have to be accept reject. I could apply a new strategy and say, if I am going to approve everyone over 41%, all the women over 41%, then I would expect 3% of them to be delinquent. The blue arrow shows that if my risk appetite, actually my business model could allow for 4% delinquency, given the costs and the margins and whatever, then I could make the cutoff score above 21 points, and I could actually approve 90% of the past applicants. So that's how you use scoring most generally. And yeah, you're basically using it, again, to control your expected delinquency rate, but also in other ways to affect pricing, limits, terms and conditions, et cetera. And we won't, so the rest of this discussion won't be more in detail about credit scoring, but I wanted to provide that background so you see that how the scores, where they come from the analysis of the past data. And then once we have the scores and the associated past bad rates, that's where we can apply strategies. And in this case, where we see that women repaying better in the past, we can apply different strategies for men and women potentially. And that brings us to gender intentional credit scoring strategies. And I'll let Maria introduce what we're going to do here. But these are the ones we studied in the guide using the data that our partners shared.
Sure. So in the guide, what we did is an example, taking a portfolio that had a 7% bad rate. And then we did as an example, how could we bring this portfolio risk down to 5%? And we looked at different strategies to achieve that. So in practice, you can apply this and keep the 7%. You don't need to use a gender intentional approach to reduce the portfolio risk. You can keep the 7% and actually grow the portfolio size. But for the exercise and the analysis purposes, we don't have data for people that were not approved. So we can't really measure what it would look like to increase the portfolio. So that's why we do an exercise where we kind of cut the portfolio risk and see how many people can we approve and how many women can we approve and still cut that risk by 2 points. But again, this is for the exercise. You could apply this and keep your same target risk and just grow the portfolio. So we did this in 4 ways. So the first way is just a gender blind approach that we use as a baseline to compare. So there we don't do any gender analysis. We just basically change the cutoff like Dean was showing in the previous one. You could pick 3%, you could pick 4%. So we just move that cutoff from 7 to 5 and look at what that means in terms of the percentage of people that will be approved. In the second case, we do the same thing in terms of moving this cutoff, but instead of doing it for a blended population that has both men and women, we first separate men and women and then find that 5% for each group separately. And we see what that means in terms of how many people get approved. And then, so those two can be done without redoing the scoring model. So even if you don't do your scoring models in-house, as long as you have the scores for people and you have the gender information, you could apply number 2 without the need to redo a score or even having the equation for the score. Then 3 and 4, you would need to redevelop a score. So number 3 is where we incorporate the gender variable into the model. So like what we saw in the beginning, when we consider different characteristics, we add gender as a characteristic to try to capture a little bit of that difference. And that will capture some difference, but because men and women may have different variables that are relevant for them, it will not completely kind of account for that difference, but it'll account for some of it. And then the number 4 is kind of fully developing separate scoring models for men and women. So in that case, you would fully account for those differences because there's more flexibility for the model to pick different variables and different weights depending on gender. The caveat is that number 4, you would need to have more data available because you need enough data to develop 2 scoring models, while in number 3, you're combining the data. So the more data that you have available, the bigger advantage that you'll have in terms of developing separate scoring models. And on the other side, if you don't have a lot of variables, you don't have a lot of, you know, very large samples, 3 might be a better starting point. And now Dean will just show the examples for each one of these.
Okay, thanks, Maria. So as I took that break, I saw that Maria warned me to speak slower. So I'm sorry that during the first half of the webinar, I didn't do that, but I'll try now. And then please, so also if you have questions about stuff we've already gone through or things that you'll hear now, if you either write them in the chat or note them down, we can discuss those in the Q&A too. So again, I get, it's not that I get excited. Anyways, I just start talking too fast. I'm aware of this in my international practice. So yes, if we start looking at cutoff strategies, and as we were working on the guide, we tried different things too. So the gender blind cutoff score is going to be our baseline here. So as Maria explained, our premise, so that we can back test the strategies, our premise will be that we need to reduce risk. So let's say 7% didn't work for the product again, or for whatever reason, or for a strategy you're going to apply, and you need to only target the borrowers that will give you a total of 5% delinquency rate, right? So when we just want to set that cutoff score for everyone without looking at gender, we have to find the one cutoff score that will, like I was showing in the policy table earlier, we'll find the arrow where the cumulative bad rate is 5%, and we'll get some percentage of the population. And actually, strategy 1 is shown. So we have the general cross table that I was showing earlier for gender, using this time bank data that they shared with us to do this research. And if we set the cutoff score to give us 5% without paying attention to gender, then we would approve 78% of the women who borrowed in the past, and 78%, well, you know, so basically 79% of men and women if we were rounding, right? But it's almost the same as it turns out. But the bad rate for women will be 4.3%, and they're that larger share of the population again. And the bad rate for men will be 6.4% for that group of men, and the average bad rate would be 5%. So you see, in one way, if equality or, you know, parity was by having the same approval rate for men and women, you see this by chance, in fact, works out to have about the same approval rate, but it's in some ways, you know, arguably not really necessarily fair, because our risk target is 5%, and women are coming in below that when we set the one cutoff score. So there's more women of our past borrowers who would qualify if we were just looking only at you know, them in isolation, whereas with men there's some who would not qualify because they exceed as a group, you know, our threshold. But in fact, very many lenders don't or I should say most lenders don't have separate policies for approvals by gender. And in fact, Time Bank, it might be on another slide, but who shared this data with us specifically cannot and does not use gender in their lending decisions. They have it in their data, but they're, like in the United States, you're also not allowed to use it in a scoring model. So that is the case in certain markets. But again, in the many of these, in most of the 60 countries I've worked in, it's not regulated, and therefore, taking gender into consideration usually, I think, is a good idea in scorecard development, because it does benefit women, and it doesn't generally add risk. In fact, as we've already mentioned, but the easiest strategy then to apply, and one of the most effective ones to a certain extent, as Maria already pointed out, is just to set separate thresholds for men and women, because then you can just precisely identify, based on your past experience, what women scoring above what level will allow for all the ones who fit below 5%. And with this data set, when we apply that strategy, then we can apply 88.5% or almost 90% of past women borrowers. The flip side of that is when we set the threshold for men, as we saw, the men were repaying, repaying late at a higher rate, or repaying worse. We have to curtail some of the lending to men. So that may or may not seem like a good outcome, but as we'll show when we summarize it, it actually should increase total lending. So again, it's something that can be used to certainly increase the number of loans to women, but it won't, increasing the number of the loans to women won't increase the portfolio risk, right? Decreasing the loans to men, again, if that went against some other goal, it might not be what you want to do. But that's so that's that. And as Maria said, the good thing about this strategy is if you didn't develop the scorecard yourself, for example, if you're using just a bureau score, which, interestingly, depending on the product population, the bureau score might not work equally well for men and women. I've seen it work in different ways, but again, depending by the subpopulation and the product that you're scoring. But or if you have a vendor or someone's developed your score, you don't need the details of the score in order to apply this strategy. All you need is, you do need the data that we've shown in the beginning of the analysis. Basically, you need loan level data, you need the gender, you need good and bad outcome, and you need the score. So you do need the numeric score, but you don't need to know its contents. Whereas, oh, sorry, and then I want to speak this. So how do you set that threshold exactly, right? So we showed a cross table where the policy table where we can find the score bucket and all the ones above it. So we said, where we're going to have 5%. So you can make those separate tables for men and women, and you may be able to see from those tables. But what we present in the guide, and I'll again go into the exact details of this in the next session for anyone who wants to stay and see how to do this in Excel, R, and/or Python. But essentially what you're doing is you just need the score data. You order them from lowest to highest score, and then you add up the cumulative bads per row. So in like the example data set in the data pack that comes with the guide, I think there's 5,000 approved loans in that data set. And so you're sorting, or maybe it's 7,500. Anyways, you're sorting all those from low to high score and looking at the cumulative bad rate. And then you have a formula or a way to find right when you hit the threshold that's your target for men and for women. So 5% in this case. So I say we'll go over that, but that's how you do that. And then,
so if you go just one back, just to illustrate, Dean.
Yeah.
So here, let's say this is the general one, right? So when you look at the sample as a whole, a score of 50 leaves 5% of results in a 5% cumulative bad rate. What you would do in the gender intentional one is separate that, and you would find that for women, the score that leaves 5% is actually lower. It's a lower score. And for men, it's a higher score. So in practice, what you would be doing is just finding that for the separate groups. So instead of approving everyone that has more than 50, you would require a lower score for women and a higher score for men, just slightly lower, slightly higher, to bring each one of those to 5%. And so that way you would kind of make sure that as a group, the ones that move forward and are approved have the same rate regardless of their gender. And then you would end up with a larger total sample to get to that 5% because you're able to add more women by just kind of lowering that score. Go ahead.
Okay. Yeah, thanks, Maria. And so the next two strategies, as Maria presented, will be where you actually go back and redevelop the scorecard in one way or another. But the simplest one is kind of what we've touched on in the gender lens analysis, and it has this. In some ways, it's very similar to setting a different cutoff score. So if I've analyzed in the past that women have, like the very first example we saw, 5% bad rate, and men have a 10% bad rate, and the points in scorecards, one way or another, they kind of come from the differences in the bad rates from groups. And so let's say the difference of those 5 percentage points in bad rate, 10% for men, 5% for women, that was 5 points that I got in a scorecard, and then I add that to women, right? So what that does is that increases women's score. And then even with a single threshold, more women are likely to pass, you know, because their lower risk is being reflected by the points in the scorecard. And so that's, even if you didn't know that that's how scorecard points, that they reflect kind of differences in the bad rates for different characteristics, and you learned that today. That's really one of the most important things to know about scorecard development, I think. So when we, if we still use a gender blind cutoff, we use one cutoff, but we give women more points to reflect that they're lower risk, that also helps balance things out. But what you see is, again, we're comparing here on the using gender characteristic in a scorecard. We're comparing our baseline case where we just had this single cutoff with now having this characteristic added to the scorecard. And what that does is it increases the share of women that can be approved from 78% to nearly 85%. They're 84.6. And the late repayment rate for women is higher now because we've included, you know, the women who more of the women who had the worst, you know, less good repayments. And then for men, we're also, it ends up not, so men get, usually the risky group in scorecards will get 0 points, so men don't get any extra points, and then not as many of them will pass, and that's why it goes down a little bit, like the share of men that pass through, and their bad rate also goes down a little bit. But we still end up, like with that solution, it doesn't allow you to let's say increase the lending to women as much. On the one hand, it doesn't require you to curtail the lending to men as much either, but it's not, basically it doesn't increase the total loans in the same way that you can get by using the separate decision threshold. So if we look at the last strategy, that's actually, as Maria mentioned, when you have enough data, for several reasons, you know, I've thought about it, that will give you probably the best result. First of all, if you have a separate scorecard for men and a separate scorecard for women, it will just likely be more accurate for men and women. And it's also because if we get to it, for people who stay on for the data part, you know, when we use this data provided by Time Bank to do the research, they have a lot of transactional variables that come from the bureau in the data set that they shared. And I didn't, but it's not their model that we use. So they provided us their score, but they gave us the source data that they use, and we just made our own models, right? But what I want to say is, when you have transactional data, you find that for certain types of transactions or things related to income, that the patterns for men and women will be different, right? So they may be in general the same, like the more income you have, the lower the repayment risk, but the women will have lower repayment risk also at a lower income threshold that can reflect income disparity, you know, in a economy or setting, or that they, you know, like usually you find things like more transactions of certain types can be associated with lower risk, but probably the places where the relationships change for men and women will be different. So if you model them separately, you'll get a more accurate model predicting women's risk and a more accurate one predicting men's risk, and then you're able to target more effectively as well. and because you have separate models, you'll be setting separate cutoffs. So that's like taking out all the kind of things you can potentially do, and therefore it will usually, again, probably give you the best result. Of course, depending on how much you do credit scoring and your resources, if you make 2 models for every model, you have twice the model management and other things to go with it. But it's probably the way, for a given portfolio to maximize the increase in lending you can do to women. And we'll summarize the table now. I guess to do other, if you read the guide, we have the data from Time Bank that they shared, and as I said, they don't use gender in the scorecard because they cannot. But in another bank that I worked with, AB Bank Zambia, which is part of Access Holdings Group, they did, and actually very many financial institutions I've worked with have used gender in a scorecard, as maybe many of you have, if you have scorecards, and they used it not to really make a gender intentional strategy of the type we're talking about now, but just because it's a demographic feature and it tells borrowers apart by risk, as I said, and it favors women. So I think if it, it has, or I work with a lot of financial institutions that have a goal or a mission to help women, like microfinance or banks working on trying to expand finance to women. So it has a bunch of kind of good reasons to use it, and it just helps the model rank risk better. So in the case of AB Bank Zambia, we developed a scorecard with them in 2019 and analyzed 7 years, which is kind of a lot. 3 years is enough usually, but so we analyzed 7 years of data, and in that period, they had 57% of their loans to women, and women repaid it in that data set of a rate of 5% bad, and men were 7%. So much like the Time data, just by coincidence, I guess. But they again had men repaid 2 percentage points worse in terms of late repayment, or more often in late repayment. And so that was a characteristic in the scorecard that received, X number of points, 5 points, 10 points, I don't remember what it was. But once they put that scorecard into production in 2019, and then they started a process for scored loans, which was not all their loans, but it was a subset of the portfolio, the ones that went through mostly fully automated scoring process. As a result of including that characteristic, it did increase the lending, the share of the lending that was to women, so by 3%. So 3% more loans went to women than they had in the past for that portfolio. But importantly, the bad rates for men and women both decreased to 3.5%. So that, on the one hand, that's not the outcome you necessarily expect, or that, because the fact that it decreased is related to things outside of that characteristic in the scorecard, right? But the idea that's important is that it became equal for men and women. So now you're increasing the loans to women, and you're getting the same bad rate for both genders, and that arguably is the most fair and appropriate outcome. So it was an interesting case, and we include in the guide of the strategy working. When again, that wasn't really the motivation of using it initially, but it did work. And then of course, just in general, as an aside, if you have gender, I would put it in the scorecard. If you have an issue with giving points to women for any reason, or if women actually are higher risk, like they are for credit card debt in America, apparently, then you could also not use points for it, but having it in the model also can help just in terms of controlling for the relationship of gender to other characteristics in the model. So I think it's a good technique to include gender as a characteristic when you can. Okay, so if we come to the summary of the 4 strategies, I don't know, do you want me to talk through this, Maria, or did you want to?
Yeah, go ahead if you want.
Okay.
I can also come in.
Okay, no, I didn't know if you. So what we see, we start again with the baseline, the gender blind single cutoff. So that's what most banks would be using. Then again, some of the ones that I've worked with would be using strategy 3, but which is having the gender variable. I have something blocking my screen here slightly, so I want to, oops. that what you'll notice is as we move through those 4 strategies, per 1,000 customers, we see the number of women approved increasing. So it goes from 534, where we actually have fewer women and their bad rate is below our risk appetite of 5%, to it going up using separate cutoffs, but there, without having the gender variable in the model's not as accurate at identifying the risk associated with gender, such that we get almost in a certain way identical results. 2 more women per 1,000 approved by having the variable in there with a single cutoff. But that model is preferable because if we look at the far right, or that strategy, modeling strategy would be preferable because the total borrowers goes up, and having the variable gender also helps apparently to more accurately select men, as we're able to approve more of the men, right? But again, with that strategy, you have the disparity in the bad rates. So the very optimal strategy would be if you have the 2 separate models, then you see you can increase, or so you could approve 10% more of the women, so from 79% in the first column there to 89%, and then you actually only lose 10% of the men, whereas, or I shouldn't say only, that's probably the most I'm looking at. But so so that's the trade-off, right? That you're in this scenario where men repay worse, and you're trying to lower the bad rate, you'll remove more men borrowers. As Maria pointed out, and what is important to this, the big opportunity is that if your portfolio is actually within your risk appetite right now, and you find that women repay at a better rate or have a lower bad rate than men, you don't have to cut lending to men at all. And what you need to do, or what you would want to do if you see that there's an opportunity to expand lending to women, is you would lend to new women borrowers, which is taking risk because you won't know. So if you remove one condition or something that you used to use to restrict lending to women, and now you make these other women eligible in whatever way, or you lower your existing scoring cutoff score for women alone and not for men, you'll take some new risk, but that's your way of testing and expanding your market until you see the result, and you may see that you lower your cutoff for women, and you actually don't increase the risk up to the threshold of your risk appetite, and you can do that some more. But here you see in this result, this was with one set of data that we tested these strategies, and obviously with another set of data, we would test them, and we probably see similar results, but they would, these they're specific to the models we made on the one hand, but I think the general order and principle is right, that you get quite a big effect just by using separate cutoff scores for men and women with any scoring model without changing the model. Then if you put the variable gender in, you'll also get a good effect, but if you don't set separate cutoff scores, you'll most likely have disparity in the bad rates, I would guess, between men and women. One option that's not on the summary table is you could put gender in the model and plus set separate cutoff or separate decision thresholds, right? Or you can have the separate models, but for the reasons we mentioned, it would be more accurate on women specifically and more accurate on men. That would be likely the one that gives you the best results. So I don't know, Maria.
Yeah, let me give it, and there's a couple of questions. Just I think one thing I wanted to highlight is that if you have an interest in lending to more women, then these strategies would give more loans to women. But even as a provider, if that's not a focus, as you move down these strategies, you have a larger total portfolio. So as you move down, you're not only lending to more women, but you're able to lend at the same level of risk to more people, so likely more profitable. The other option, like I said, here we're assuming you cut down to 5% and looking at how many people you're able to keep in your portfolio while doing that. But alternatively, you could keep your original portfolio size, and these strategies, if you kept the portfolio size constant, what would happen is instead you would have different risk, basically. So you could also keep your portfolio size and just use this to see what the difference is. And you would see that for the same portfolio size, the higher strategies just have lower total risk. So either by lowering the risk or by increasing the size, as you move down these strategies, you're getting kind of better value as a provider, in addition to the higher lending to women. And then the other thing to point out is, while, as Dean was saying, we expect this to be ordered in this way, the additional value that you get from one strategy versus the other, it would depend on how much data you have. So there's a question here on which strategy would work better, specifically using alternative data sources for women with no credit bureau footprint. So I would say that doesn't matter what data you're using. It's more about how much data you have. So if you have very little data, both in terms of how many variables you're able to put in and the sample size, the more sophisticated approaches would add less value. And the fourth one, you need to make sure you have enough data to build the model robustly, right? So it doesn't matter what data you use. If you have enough data, whether it is alternative or traditional, the more sophisticated approach, the lower ones would give you better value. Now, if women have no data, no credit bureau footprint, and you have very limited data, there may be less value or less ability to develop separate models. But it just really depends on the data quantity, not necessarily which type of data. And there was another question that's related on what parameters or features would you consider in building a credit score model, particularly for the unbanked. So really there, I would say any data you have, I would test. So there, it's less about thinking which one's the best one and more what data can you get, right? The main challenge with those groups is just there's not enough data that's digitized. We've done, if you are able to get something that links more directly to income, generally works well. I can put in the chat, we have a paper looking at transactional data and how it compares to credit history and how it works for people that don't have credit history. So if you have something like a digitized transaction, something that links to the income of the person, that generally performs well. But with those groups, you're really looking at what you have rather than what's the ideal. But maybe Dean, you want to say something on those questions? I think they're related.
Yeah, no, I think you answered it well, Maria. That as Maria says, so if you have alternative data for women or for for everyone really, you want to consider those data points. What Maria was referring to, like in the transactional data shorter brief that we did with CGAP, and with other research I've done in different capacities. I think you can compare, anytime you have alternative data, you can compare its prediction to bureau data or credit history for borrowers who have it, right? So obviously the goal for a lot of cases is to be able to evaluate people who don't have bureau data. But if you have a set of data, alternative data for people with a bureau report, you can kind of gauge how well it works, at least on that subpopulation, by comparing it. Because what you'll find is that as you have more and more predictive data, it's not additive where your prediction just keeps going up and up, right? So bureau data gives you a really good level of prediction for that population, and then alternative data can improve that some, and it can give you the equivalent of that. So you can get the same prediction without the bureau data, for example. But yeah, it's when you don't have traditional sources of data, then obviously the alternative data is more and more important. And I think that one thing that is important about this whole line of thinking of how to serve women better is, yes, as you identify new sources of data, specifically if there's ones that measure things that are related to women and their lifestyles, economic activity, more than they are to men, that's, again, where your separate models would really work a lot better, because you'd be evaluating women on things that matter for women and men on at least the traditional things that I guess have always mattered for them, if the other characteristics didn't predict as well. But in both cases, I would go through the same scorecard building strategy of evaluating all the characteristics and trying to take the best mix of characteristics I could. So yeah, I don't think there's like there's any particular kind of alternative data, that some work better than others and for different products, different circumstances. Just the more data you have, the power of models, by the way, models become better by having more and better relevant data. I think that's what it is, as opposed to machine learning per se or the algorithm. So on classification models, it's really a function of what's the quality and variety of your data. So I don't know if that answers.
To give an example on how data could mean something different for men or for women, if you think about a country where social norms mean that generally like property or assets are in the name of men, right? So if you look at a variable that would be like asset ownership or whether the person has collateral, if you're looking at men, if they have it, it means they have assets. And if they don't have it, it means they don't have assets. But when you look at that for women, they would just generally not have it because assets would be in the name of men. But that doesn't mean that they don't have access to those assets. So they may live in a house where they don't pay rent. It's just in their husband's name. So that means that what that variable tells you about a man or about a woman, it's different. In the case of a man, it's telling you that they say don't own the house that they live in and they're paying rent and they have those expenses. In the case of women, it's not really telling you anything because you don't know if they live in a house where their husband owns it or it doesn't. So it's in those cases where when you separate the model, you're allowing the model to say, this variable doesn't give me a lot of information for women. It gives me a lot of information for men. So it would weigh differently and use it different. And there can be many examples like that. And the richer the data is, the more you can find this and the more value there is in kind of separating those models. Let's see, another question. Is there any analysis available on collateral-free loans? So these loans that we use for the example don't have any collateral. These are just buy now, pay later loans. I guess maybe you could think about the asset depending on what it was, what they bought, but I don't think they were doing repossessions. These are small loans. Yeah, so the analysis would apply regardless. Now, with different people were asked for some people were asked for collateral and some people were not asked for collateral upfront. That just makes the data kind of less clean, I would say. So that's something that you would need to consider. The analysis here don't consider any collateral, and you could apply it with or without. The main issue is if in the data used to develop this, if some people were required to put down collateral and others were not, which is sometimes the case. So depending on their score, people may be asked to put down collateral or not, then that can impact a little bit how reliable that data is to then build off of a different decision-making process. I don't know, Dean, if there's anything you want to comment on the
collateral. The collateral is a good example of actually, and if collateral is required for a product, right? So then you already pre-select, a whole bunch of people get excluded, and so you have no idea how they would perform anyways because they didn't qualify, based on collateral. So as Maria said, this is a retail product that didn't require collateral. I think even the example from AP Zambia also in that case was an uncollateralized loan, but I could be wrong about that. No, that one might have had collateral, but yeah, you're limited, I guess, to the extent of what data set you're studying. So as long as we're talking about a data-driven model, it's going to be based on the historic development of that portfolio and what the composition of the clients was. But if you wanted to look at, if you had both options in a portfolio, you probably, from a modeling standpoint, want to subset the loans that didn't require collateral and maybe look at those separately to see if there were different relationships, as another example. But all those more nuanced analysis require a lot of data, and also in my experience, in the huge majority of cases, especially for any kind of innovation products where you're trying to do something new, the first challenge is usually a slight data shortage up front, like to be able to lend and get data as experience to develop those models. So yeah, most people I work with or fintechs who face that constraint in their initial wave of lending is just to try to get enough data to be able to do robust analysis.
And that would be, I think, one reason to have like these different strategies, right? If you're just starting and you don't have data to build your own models, you're using a bureau score, then your only option is really to apply kind of the number 2 strategy. But then say a year later, you build data on your own portfolio, then you can kind of move to number 3. And then 2 years later, you have a large enough sample, you could apply number 4. So that you could also think about this kind of over time as more data becomes available. I think then you can go to the last slide,
Okay.
and then I'll check if there are any more questions in the meantime.
Yeah, so the last slide in the guide was meant, now obviously scoring, I think most commonly everyone thinks about using it for approve and reject of loans, right? Just meeting a kind of a cutoff score, but actually because it ranks the borrowers by risk, you can use it for a host of other activities, and including with your existing borrowers, because you know what to expect in terms of the share of bad loans in each score band. It's commonly also used for risk-based pricing approaches where you differentiate the margin you charge, or the fee or interest rate you charge based on risk. And also it could be for limit adjustment is another way it's used, that based on your risk adjusting a certain type of limit you're able to approve. And another one would be whether or not to require certain conditions or loan terms, based on risk. But this example that we put in the guide is to show that if you used that, basically to show it's not just limited to approval and rejection of the loan overall, but you could use it for pricing. And if we applied the same type of analysis, I think we use the that's numbers. Yes, we use the time data, I believe, for this analysis as well. But you can basically, first of all, this is showing. This is the table for women. So we're looking at this risk-based pricing framework for women, but where we know the margins and we know the expected number of bads, and so we estimate or assume something about the charge-off or the cost, and we can set interest rates that would always ensure a gross margin of 3 in this example. But if we do that separately for men and women, because we know that women had lower bad rates overall and probably throughout the score range, especially if it's of one model, a gender blind model, that allows us to pass on lower interest rates to women, essentially, right? So it's again giving a different strategy to make credit more affordable for women based on their risk. So it's not just based on being nice or something like that. It's based on the fact that their repayment warrants this interest rate. And so some banks don't do this, and sometimes the market is not ready for risk-based pricing, but it is another opportunity of how you could use scoring more generally, but specifically a gender intentional strategy to offer, let's say, what would be fairer interest rates to women, or to extend more credit to women who are lower risk, like by increasing the limits. I mean, in a similar way. So you basically give a higher limit to people with lower risk, and you give a lower limit to people with higher risk.
There's one more question here. When we talk about collateral, they can come in various forms. For example, some MFIs require some deposit saving and multiple of that as credit. So when we say time back or others gave collateral-free loans, that does mean that they didn't even ask for some cash deposit. So my understanding is that Time Bank did not. It's possible that people have to pay for some percentage of the product, right? It's a buy now, pay later loan. So they may not have covered 100% of the cost of the product, but that would have anyway gone to the retailer, not to Time Bank. But then I don't know if you know if the bank in Zambia asked for a deposit.
I have this feeling, and you see it was 2019, so thus my hesitancy. But I think that they required collateral, even because I recall that in general in that bank there was a issue with the way you measure collateral balances and stuff. But so I think. But what was the question again about collateral? Sorry.
Just if there was maybe not an asset as collateral, but if people had to have a minimum deposit or saving in their account to be able to access the loan.
Yeah, well, I could say again, this has really nothing to do with gender intentional stuff, but for years I've worked on leasing models, scoring models for leasing, and there basically risk ranking was used to adjust the down payment or deposit on standard assets like cars, so that if you have lower risk, you could put a low deposit. If you had higher risk, you could still get the loan, but you were required to make a bigger deposit. So again, that might not be answering the question, but it certainly, you can risk adjust the collateral levels or deposit levels for products like that based on this as well. But again, the data set that you have as your baseline for the initial analysis will really depend on whatever the policies were for a given product or portfolio, as you approach it for this analysis. So that's like the limiting factor maybe of the data-driven part of this is your data will be bound by whatever previous conditions were. So you need to be aware of those, obviously.
Yeah, so all of this analysis would apply in either case. What I would, if that's your case, what I would be careful is thinking about what has that done to the to the training data for the model, right? If you're developing a new model, and that's the main thing. Say if you required a collateral that was very hard for women to come up with, and then you may only have 15% women in your sample. So that would make it harder for you to know what women outside that group look like. You don't have a lot of women. So it'll be hard to develop a model just for women if you have a very small sample. So you may want to start with one of the simpler strategies and start relaxing those restrictions slower and see how it goes. So I think the main thing about that is understanding how it impacts your available sample and what would that mean going forward if you plan to change those policies. And like Dean was saying, we focus on the guide mostly on what this means in terms of approval and the size of the portfolio, but you can use it to determine the size of a collateral or a deposit if that is required. You could use it to look at the rate that you're charging. You could use it to look at the loan size that you're giving. So the risk-based approach can be used not just for approval, but for other components of the credit process.
Yeah, and so the difference of this from any other talk on credit scoring is that you can do that by gender, and all you need to do is just analyze basically the outcomes of your scoring model separately for men and women. And as I say, for me, it's interesting because it's not complicated to do, but it's not something that generally I was ever asked to do all these 20 years doing scoring models. People weren't really looking at it that way, but more recently, as we've worked on the guide, some of the clients who we work with IFC and stuff, we just do it by say, oh, we're working on this, and we look at their data because again, as we'll go through in the second half, for those of you who want, if you have the data or you can get your data, in a table, the basic analysis to understand what's the state of things now, without any redevelopment is quite easy to do. It doesn't take a lot of time, but it gives you some information, and then that's food for thought, and it's actually food for thought too. If you, like Maria made the example, if you have collateral being a limitation on the number of women in your portfolio because of collateral, obviously this analysis should be accompanied probably by the reasons why things are like they are, right? So in this guide, we're just showing how you can apply the strategies once, how you do the basic analysis and how you apply strategies. But of course, to put everything in context and understand why your data is like that would make it that much richer in terms of being able to make appropriate interventions for your actual products.
So I think we're ready to move on to the second part in terms of how to actually implement this. Just want to check if there's any other questions on this before we move. Please put them on the chat. In the meantime, Sarah, maybe you want to start the poll. So we just a quick poll question to see what if you use what software you use, if you use any software at all, just to get a sense of what to focus more the explanation on. We have 50% of people who responded, and Dean, if you want, in the meantime, you can start pulling up your
Yeah,
your
yeah. You see the result? I don't see it. I was just looking while here.
I'll just
how do
read out.
why do I keep seeing that? Let's see. Okay.
Answers are still coming in, so I'll give it a little bit and I'll just read out. So we have 24% of people who don't use any software. And then highest is Excel. 50% of people use Excel. Then 24% use R, 20% use Python, 9% use other, and 4% use Staya.
Okay. Oh, now I see it. I was gonna say I didn't see it. So, okay. So that's good to yeah. So I was thinking that on this, and we decided, Maria, we're not doing any kind of break or anything, right? We're gonna go into this. So just
yeah, no, I think there's
okay.
a couple more questions if you want before we start.
Okay.
There's a question just more, how do you get the score band? So are you gonna show that now, or you can just explain?
I think, yeah, I think that should be answered as we start going through more of the details. I could show it in different, but even in Excel, I'll show. I noticed today in the data pack template one thing that I thought was programmed that wasn't, but where we're setting the score thresholds, generally, very generally, it would answer your question in a general way. When you develop a score, most best practice says that the first look you would have at your scoring model would be to break it up proportionally into deciles. So you just like take 10% of the scores and you make 10 different groups. So you have kind of an unbiased like view, or I also sometimes just force it into the shape of a normal distribution so that you have the very highest and lowest risk in the tails, then you have more average risk in the middle, but you use some kind of arbitrary strategy to initially look at scores. And then after that, you would want to, depending on how much data you have and all that, you would want to make as many risk buckets as you have meaningful differences in the risk levels of the client. So, but kind of generally it's between 7 and 10 or 15 in some cases, but right. So you just kind of, I'll show in the thing I use, I would make a proportionate cross tabulation mainly to look at it at first, and then you can tinker with it. What you're not supposed to do is make like 4 groups where 80% of borrowers are in group 2. That's like, I've seen that happen in practice, but that's not how it's supposed to work. So
there's one more question on how might credit guarantees for women influence the scoring. So if you mean like there's someone else that's kind of offering a guarantee to the lender to reduce your risk and eventually would cover loans that are lost, that wouldn't affect the scoring, but you may want to change your decision based on that, because your risk, you would still rank women by their risk, because if I understand the guarantee, the borrower is not involved or aware if it's that type of guarantee. If it's someone that's a co-signer, then that's different. But if we're talking about a guarantee that goes straight to the lender, it wouldn't affect your scoring. It may affect, depending on what the guarantee is, the risk you're willing to take on that segment, because your losses are lower. So it wouldn't change how you score them, but it may change how you want to make that decision in terms of who to approve. If there is a co-signer, that definitely makes things more complicated. I think it would depend on the market and understanding eventually how many times is the cosigner responsible. But those things really matter mostly if you're going to change them, right? If you require a cosigner for everyone and you're still going to require that, then that matters less. I think how those things impact behavior matters more if you're planning on changing them. I think you can go ahead, Dean, now.
Okay, yeah. So I see actually that we still have a lot of people, which is good, I guess. And as Maria mentioned, though, there's not going to be a lot of new or any, perhaps to some extent, what we're doing now and so if you've seen the guide or not, but with the technical guide, there's a link to this data pack that basically has examples based on a stylized version of the data that we were using to create the guide, and with Excel templates. So that was 50% of you are using Excel, and actually, quite frankly, and I'll be starting by showing Excel, because Excel is not very good for developing a scoring model, right? Because you can't, it's not scripted. You have to do it step by step. It would be kind of clumsy. But Excel is actually very good for looking at reports and analysis, because in some ways it's easier to format, and well, easier for me to format than like formatting in Python and R is just like writing a lot of code with details about the formatting or whatever. So I also just think it's going to be clearer and easier to show how this works in Excel. But what this part, and so if this level of detail I want to say is more than what any of you are looking for, it's we'll just go through with the data set that's in that data pack and showing how it works in Excel where it's easiest to understand, and then I'll show how it looks in R and Python at a very general, or like just at a level to show maybe those of you, so if a relatively large share of you are not using R and Python, you can just see what that environment looks like. As I say, it doesn't really make much advantage for these looking at these gender analysis tables to use R or Python. But if you're fluent with R or Python, you might find them easier to do the analysis in, and you would also probably not need the code that I provided in R or Python, because you would code it yourself however you want, right? But I will just point out about those other packages, how we get the same results, and briefly what's the advantage of a scripted language because of the libraries and functions and things like that. But let's start then. And again, if I think Maria is monitoring the chat, so if there's something like that's unclear right away or whatever, just write a note in the chat, and I think it should be pretty clear. But if you were to download that data pack thing, it's just an archive with 4 or 5 files in it, and one of them is this Excel file that I don't see the name of it, but anyways, it's called something, and I guess it has this blank note sheet that you could write something on. But what it has, so here's the data set, and much as we were saying in the first half, the data that we're going to need to do all this analysis is very little data, really. It's just we have a loan ID. So each row again is a loan, right, or a loan application. It's a loan application in this case because we're doing the initial gender lens analysis. So we have some ID number usually, and then the decision. And here the decision would be approved or rejected. We have a score, because if you have the score, you can do the full analysis. If you don't have a score, you can do the initial analysis, which is just the gender lens table that we'll see. You have gender, male, female, and you have good or bad loans classified. And I've got them in this example data set, and usually we'll code them for modeling as 0 being a good loan and 1 being a bad loan. And that's because most credit scoring models are classification models that predict a probability that's between 0 and 1. And 1 is the target of what you're predicting, which in this case is a bad loan. So I've coded them this way. But if you were, after this workshop, also to go and just, as I say, pull out some data from your own portfolio or some data you might have, you could just, basically leave, I don't know if the header names don't matter in here, but you could just replace, remove these rows, and in the same columns, place your data on decision, score, gender, and good, bad loan, and then move to this template. And you see, I've put some notes in here where it says once you load the data, et cetera. But what you need to do is just put here how your data is coded. So if yours said women and men, you would put those words in here, and then you know, if bad said good and bad instead of 0, 1, you could put that in the exact same type. And what would happen is what should happen is that then you'd get these tables that we look, the basic gender lens analysis tables that are in the guide should populate, because these are just formula-based Excel tables. And as I said, Excel has the advantage of being maybe easier to understand. You don't have to do much programming, but these are just using countifs functions. So it's looking at data column D that has gender in it, and it's counting each case where gender is female, because I'm in column B. You see, and here I have it labeled as women, but it's counting where it's female and where it's good. So in column E must be the yeah, sorry. So it's counting the decision, it's counting the gender, and then the good bad status, and then the decision has to be approved, because we can only for loan repayment look at dispersed loans, right? If they're rejected, they would not be issued nor repaid. And so just using those COUNTIF formulas, it's tallying up, you know, the number of good loans, number of bad loans, and then this is the and the number of total loans, which you see is these two for women. And the bad rate is 6%. And these are the same as they were in the guide. I think it just had another decimal point there in the guide. But and here, usually in a cross tabulation, like the kind that are generated in R, you'll have the column-wise total. So you'll have actually what's 3, if these are for the row, right? This is going to be this number of bads, 220 divided by 3416. This number is going to be it's going to be divided by total loans. So 3416 here divided by total loans. And that gives you a cross tabulation. As I'll show you afterwards in R, you know, if once your data is coded, you just there's a function that does that, but it's not hard to do in Excel too, is what I want to show. And so for a lot of tables, and this second one here is an example of another cross tabulation, except here we're looking at accept reject rates. So the difference is that we don't look at the data on good bad status. We just look at, we count if it's coded as woman, and if it's coded as approve, or if it's coded in reject. And then in the same way, we divide the number of rejections by the column total, and we get the rejection rate. And then we have the share of applications of the total. So we see 69% women applicants, 31% men, and the rejection rate is 31% for women, 28% for men, and the approval rate's just 1 minus the rejection rate if you want to present that. But so cross tabulations of that time, and then this is just a presentation of the summary of that information. So if you could obviously see it from these two cross tabulations, 2 and 3, but otherwise, if you just wanted to present in a meeting or to management, you know, I think these are the key metrics you get from a gender lens analysis without reference to the credit score. It's just to know what share of loans what share of loan applications come from men and women, what's the approval rate by men and women, what's the share of the issued loans, you know, so they go through to issuance, and then what's the bad rate, and particularly the bad rate that's going to inform the next steps in the analysis. And then if you do have the score, like we do in this data set, what the Excel template does, that this is a little bit imperfect, but it basically, you could, if you have some data on your own loans, you'll see this, it's not so clear, I guess, but this has a number in it. And yeah, so can do this better, but it has a bucket width of 10. So if actually you had your scores and they were on a scale of 500, and you wanted to you would have to make bigger buckets, but to get through your score range, but you could adapt it like that. And I thought these were formulaically linked, but they're not. But anyways, you could look at this part of the score bucket, and because I think the formulas are, yeah, they're linked over to this. So you would you could change the scoring scale, right, and break that in here in Excel to however many groups you want. But the way I had it was sorry. Well, I can put it back to what it was. I was just going to try to reset it. I didn't see undo over there. So yeah, but so when it's like that, you know, again, these are, so what it's doing now is it's going back to that same data sheet, and it's just counting the number of good loans that have a score. You can see that have a score above 91 in this group and are good. And here it's doing a score between 81 and 90, et cetera. And basically all, because it's a classification model, all the scoring analysis is kind of always just counting good and bad loans and calculating bad rates, and then using the information in the bad rates to do your scorecard building, if that's what you're doing, or to also inform your policy decisions. So if you remember the table we were showing about cumulative bad rates and cumulative population, this is taking, so in this one, it's just the bad scoring above 91 and total above 91. But like for each subsequent bucket, it's all the bads, so in groups or 81 and 90 over divided by the total. And it does that for each subsequent group. And so so we know that if we make our cutoff point here at 80%, we would have no bads in this particular example, right? If we cut it right here at 11, we would have 5% bads. This is for women, apparently, with this example data. And then we see the share of the population would be the approval. It's not summarized as cumulative here. I'm just looking at that. So I was presenting it as cumulative, which would just be summing. It would be summing like this if you did it in Excel. So you would sum F38, in this case, the F38, but you would take the cumulative sum and put a dollar sign, a dollar sign on them. Sorry. Why isn't that working? Oh, there. And then, yeah, and then it would be cumulative like it was in the slide. So there's an opportunity to fix the template. Sorry about that. And basically,
one question before we move to the next table. There's a couple of questions on how large should a sample size be. So really what you're looking at is not the total sample size, but the number of bad loans you have, unless you had more than 50% bad loans. But what you're looking at as a minimum you look at for scoring is how many bad loans do you have in your sample? And their different score developments will be comfortable with different numbers. So I let Dean say what he suggests. I think the question is, what's your alternative, really? Because when you have few, the model is less reliable. When you are comparing to what's your alternative. But Dean, you can say more on that.
Yeah, well, I think in the CGAP guide to credit scoring, we put a number, and I go ahead and throw that number out in discussion, sometimes 300 loans, right? Sometimes people say 500. Of course, you could build a model with 100 or do analysis with 100. And as Maria said, the less, and the real problem is with sampling and just chance, right? So the less data you have on bad loans, the bigger difference it makes to this type of analysis. If you remove 5 of the loans or 10 of them, you know, that you actually see a meaningful difference. Whereas if you have, you know, in the ideal situation for scoring, if you have 5,000 bad loans and 500,000 good loans, you know, I mean, if it's unbalanced, lots of times scoring data is really unbalanced like that. But as long as you have a big absolute number of bad loans, then you find that your results are very robust, and you can take different samples and you always get the same results. But if you have, like I've had the data that we do on pilot studies where it's you make 1,000 loans and 100 go bad, as an example, then you're limited because, as again, maybe 20 of those 100 have some kind of idiosyncratic reason why they went bad, and so they're like noisy in the data. And depending, we didn't talk about it, but those of you who develop scorecards, you know, you basically develop any predictive model by taking a random sample of 60%, for example, or 70% of the data. You develop the model, then you test it on the other part of the data, and that's how you know whether the relationships you're modeling exist more generally in other data. So your model works on data it hasn't seen, and when you see that that's the case, you have confidence that it will work on your new borrowers. But what happens when you have small data is, even if that data looks like you see relationships that make sense and you make your model, you'll find that as you change your sample, you draw a different sample, that your results start to change. And that's not necessarily that the data is bad. It's just that that's chance and having small data. So again, like Maria said, people use small data when that's the only option, right? Obviously, the more data, the better. And the kind of the catch-22 with scoring is, in order to make a more robust scoring model, you have to have more bad loans. And when people are rolling out a new product, they're averse to having too much risk and too many bad loans. So they don't want to roll out all the lending. But if you really wanted to develop an unbiased model and you had a good lending process that you put in place, you would just, in one wave of lending, kind of lend to everyone, no matter, as long as they met, you know, some very minimal criteria, and then use that data to build a model and be able to select them out. But what happens in reality is very many people are selected out earlier, and so you have data on only people who passed a bunch of qualifications, and that's where you get something, and I'm sorry to ramble, where you get what we didn't talk about, but why we were using that analysis of lowering risk. It's because you never know what happens with the people you turned away, right? So what I'm trying to say is, if you can tolerate risk or have a guarantee in place for a pilot project or something, in your first wave, if you can take more risk than you would normally, you'll get a much more unbiased indication of how characteristics are related to repayment. But it's difficult to do in practice. So.
Yeah, ideally from a data perspective, you would run a pilot, you would just lend to everyone. So you can see exactly what your incoming population looks like. And that would be the cleanest data to develop a model. In practice, that is generally done more over time, where you start with something more restrictive and then go relaxing it. But that just basically means that you're going to end up redeveloping the model at each iteration. So just to clarify, the numbers in was saying like 300 or 100, that's not the total sample, right? Those are the number of bad loans. And the model will run with under 100 bad loans. It's just, it will be unstable. So if that's the only thing you have and that's what you've used, then you can run it. But then as soon as you have more data, then the best thing to do would be to run it again, basically. Yeah. And to update your model more frequently until you can get to a certain number of data where the model is more stable.
And it wasn't a question, but because I have this preference for modeling, also just, even though machine learning stuff can be cool for some kinds of data, the more complex methods are even more inappropriate for really small data. I just want to say that if you don't have a lot of data, don't try to do something really complicated, because that would just overfit the little data you have. So with credit models more generally, what you'll generally see is kind of clear, almost linear relationships for a lot of things that don't benefit so much from more complex methodologies. But I just want to say that always be careful doing too much with too little. So the smaller your data, the more logistic regression would be appropriate, and something very simple, just because otherwise you won't understand as much where some of the results are coming from. So these cross tables, so basically all these tables in Excel are just counting up so that you can see. And now we didn't, this table here, so that was where we see the bad rate by scores, right, for women, and then we can see the bad rate of scores by men, and we know already from our summary table they have different bad rates. But we do have this table that I find helpful. We didn't go over it in the presentation, but if you compare then, we can look at, for a scoring model like this one that's developed for men and women, if you look at the overall bad rate in each of the bands here, and then you compare the bad rates for men and women, and this column is just showing the difference, what you would see from this analysis. And this is again where you can see if there's an opportunity to improve your model to somehow better reflect the risk of women also, because here you're seeing in red, because this is it's subtracting the bad rate from women by the bad rate from men, that women throughout the score distribution here, it happens to be exactly the same, most likely by chance also, quite frankly. But through lots of the distribution, women have a much lower bad rate at a given score than men do, right? But your score is, when you're assigning this score, as I said, so it means that in a gender blind approach, someone will score 15, and you'll say, okay, this borrower is 13%, 13 in 100 are likely to be bad. But in fact, for women, it's just 11 in 100. And for men, it's 16, which is a lot more, right? So there's kind of a noticeable difference. And that's where these distortions come in. But this table will show you, you could find, and I have found, trying to, as I said, apply this just to see to some clients, you might find that actually there's very low differences. So if the differences were less than 1 percentage point or just 0.5 or 3 or whatever, then it's probably, it's by chance. There'll always be different. Like I said, this is by chance that it says 0, but anyways, that just gives you an idea if your score is equally representing risk across the distribution. Maria, how do we handle, I see we have a hand up. Or
if you're able to put your question in the chat, then do that. If it's too long, then maybe we take it in the end, but let's not take live questions in the middle because they might not relate to what we're discussing now.
Okay.
So if you can put it in the chat, put your question in the chat. If not, when we're finishing with the Q&A at the end, then you can pose your question.
Yeah. Okay. So that's what it looks like in Excel. That's the main gender lens analysis of, these tables are, these first few simple cross tables are just your basic kind of what's the state of the situation for lending outcomes. And then if you have a credit score, it will show how well is the scoring model ranking the risk of men and women, or assigning the risk, how fair is it in terms of, does it have similar bad rates? And then the other thing that we covered is the strategies, right? But for the strategies, actually, it's just the real strategy that we're able to illustrate in the guide and that we show here in this data pack is you would, and this is linked, to the same data set that you can bring into R and Python, but you would take the current portfolio risk rate, which is 7%, as we've seen in the example, and you would choose a target rate that you want to lower or raise it to here and enter it into this particular gender intentional strategy sheet. And I can make it 6 instead of 7, and that will change my formulas here. But if you remember, what this is doing then is it's setting this target rate here. And we have one cutoff for gender blind, where you can see that in this data, we have men and women together. We have their decision, the score, we have, and then there we have instructions. So obviously, again, whenever we're looking at outcomes, we only want to take approved loans, because reject loans will not have any repayment. So if you miscoded them, you might think they're good, but they're not, they're rejected. So so what you do, and it has these instructions, but if you're doing it in Excel, with your own data, you actually do have to do this step. So the data is here. You would, like I mentioned, you could plug your data into this template and then look at the gender lens analysis, but you would then need to copy it over like to this gender blind one, and you'd put all your data, and then you'd filter it, for example, by approved and rejected, and you take only the approved ones or sort it by approved and rejected, and remove the rejected ones, because for this analysis, you only want to do approved. And then you would sort from the lowest to the highest score. And it has these formulas that count the number of cumulative bads, starting from the other end of the distribution here. And also the cumulative bad rate that we were showing. And so this is just using a formula, a kind of a complicated formula, but effective one in Excel, to basically find in cumulative bad column where the cumulative bad rate hits 5%. And so when you find that cell, and actually I forgot now how to do it. I figured it out, but you can see which cell it is, but it's some row down here, and you can also just find it in this less, it's going to be somewhere around here, and the score is 19, right? So it will, if you put out more decimal points, sometimes it will hit it in one place. As we showed in the presentation, actually with the lenders I'm working with, no one is really doing this, this sorting and picking out a particular cutoff score. So I tried this out for this strategy. Mostly if you have enough loans and you look at a table, you can also find your rate in a scoring band, right? But you wouldn't find the exact cutoff score. And the thing I want to say about exact cutoff score is, of course, it's not that the future is going to be exactly like the past. So I could say it's 19, but if I made it 18 or 21 or something, it's probably going to be, you know, plus minus pretty close. But this is the way you can target it exactly. And so that's one is gender blind, and then there's two more worksheets where you just basically use the same formula and same approach for loans only to women in this time. So now you're going to find the cumulative bad rate for the women borrowers in the data set, also with scores ranked from low to high. And that same indirect formula here will give you a cutoff score of 10 for women. And then for men, here you've separated out the male loans. And again, that same formula will show you that it's 20. So that's the idea that where men have a higher bad rate, they would be subject to a higher approval score, and women, you would be able to lower the approval, or as we were saying. So in this case, in this specific case of time, bank data or a stylization of that, if we wanted to increase or if we didn't need to reduce the bad rate, we would just increase lending to women. But again, in some, not knowing a cutoff score for this particular analysis, because we see, this is again about rejection inference, even from time banks data that they share with us, whatever their cutoff score was, we just know it's approved, rejected. And so we are subject to whatever was their previous approval rate and previous approval score. And we can't know what happens with the loans they rejected. But we know in principle that if we take people who either score lower on a new model we make, or well, not score lower, they'd be the lowest scores, you actually just have to take new risks. So you have to probably relax a condition and lend to some women who you didn't in the past. And that would be how you expand lending from a existing scoring model if you're not looking to reduce the delinquency rate, essentially. So, okay. So are there any questions we want to take before now I can just cut and show, and that's, and this, but there's this example of the risk pricing framework. So if you're interested, I could go through, it's really the same thing. It's cross tables again, you know, counting goods and bads by score band, cumulative bad, the population share. But then you have these blue shaded, I'm trying to think even how this one works, sorry, but you have a target gross margin, and I'm guessing that adjusts these formulas, but I don't want to show it to you on the screen. But I will, it has the details of that. Now, the thing to say about this example, it's an example of a risk pricing framework, and it's simplified, but it takes the interest rate per band and multiplies that by the good loans to get an interest income. And then it takes an assumption about a charge-off and the full principal amount of a loan or something like that to generate how much you're going to lose for each bad loan. So these ones are related to the bad loans, you know, and these are related to what you earn from the good loans. And that's how you're using scoring, is you know how many goods and bads proportionally you have in each range, and therefore you expect some income and some charge off. And you can, I guess, I'm just looking, so I guess you can adjust these rates here manually to try to get these all to be at one gross margin. It says in the instruction, I'm sorry, I actually didn't prepare that particular slide to talk about right now, but yeah. So and the other thing is, though, this example of risk-based pricing margin is not in the sorry, it's not in the R or Python code, I don't think. It's just, yeah, it was just an example of how you do that in Excel. So yeah, so if we don't take a question now, I could stop with that, but just show how it looks. Then I'll go first to R because I know it better, and then I'll show how it looks in Python. But as I say, for this particular stuff, like making reports or making analysis tables, cross tables have an advantage maybe in R, that they're quite easy to make. But these other formatted tables, I just tried to replicate kind of the summary tables and things we showed in the guide, and quite frankly, I think they're harder to do in R and Python. That's just my like impression of level of effort. Whereas developing a scoring model, as I say, in all cases, you would do it in R or Python because it's actually really not appropriate to do it in Excel. So we're not covering so much the development, but for the gender lens analysis, you can do it with no trouble in Excel, I think, and you can then do it. So if I show you R, you see, if anyone's seen it for the first time, the main difference between any of these scripted languages is you're kind of facing a blank screen. So in the data pack, we have a script called gender intentional something. It has a name, but I don't see it there. But and then you have these libraries, right? So you'll have different. There's hundreds of libraries in R, and actually they show up in RStudio if you put it here. They're called packages, but if you were looking on the internet, so for any kind of analysis you want to do, probably someone's made a package for it, and they're all the ones that I have loaded are listed here. So if I see like G models is one of the ones I'm using. It's in my list of packages, and it's checked because I ran this code, and it's there loaded in memory. But you basically you need with these kind of scripted softwares. I just have something in my way here on the Zoom presentation. So let me move it. Oh, there we go. So yeah, so the way R works, just if you're seeing it again for the first time or something, it shows you the output of when you run the code in this bottom window, and then the code you're actually working with is here. I just put examples of the reason these particular libraries are in that script is because these are the ones, actually they're not even all needed in this code, but these are the ones that I use for credit scoring. So like the cross table is the main function, and I want to show you that if you put the name of a function that you can see its documentation here. But so in the package G models, it's being loaded as a library because we're using cross tabulations. And actually, someone afterwards could email me if you know. But my understanding is Python doesn't have the analogous cross tabulation function, which is one of the main reasons I was using R all the time. And then the other one that's like this is another example. So I'm just showing you that you can look up, if you're connected to the internet, you can look up what these functions we use are. That one didn't run, but cut 2 is to make proportionate cross tabulations. That's doing something weird. So column AUC is if you make scoring models, that helps you to evaluate. It's like the Gini coefficient, like how powerful your model is. But if you want to try using these, even if you've never used R or Python, in both cases, so I think the main challenge, based on my work as a consultant, will be that if you haven't used RStudio before, you need to install it. Okay, so it's not hard. You just go put RStudio in Google, and you'll be taken to the latest version. And I think now you also don't need to. You should just be able to download it and then download those libraries. You can install packages. Here where it says install, and you put the names of the ones you want, or you can write code for it. But once you have the packages installed, then you can use R. And sorry, I see that I'm gone blurry, but this is something in Edinburgh because it's dark here. So it makes the zoom go out of focus. So the only thing you really need to do to adapt this to your computer and see what it would look like in R is you need to have this data file, right, that comes with the data pack, example, loan data, XL, XS, and here it is on my computer, I want to say. And so if you would you'd find wherever you have that on your computer, and then you can go to properties, and it will like tell you the name of the file, but you actually need to specifically take that location, like I'm copying and pasting it, but you need to take that and bring it in to the R environment here where it says set working. So this is a function too, but set WD, that's like set the working directory, and you'd paste the path in, and when you put a hashtag in coded language, usually it makes it a comment. That's what it means. So it doesn't try to run that code. And the last little thing then is if you're actually trying this on your own or at home, you need to double the forward slashes or turn them backwards. You can do one of those two things, but you need to do that so R reads it. But then you can put the name of the file, and this is another function here, read Excel. And it will read that Excel file into a table called data, and then this will just like show the number of rows there. I can check it's 7,150. I guess that was in the data. And like this function here will show a description of that data set. And here I have it pasted into the code as well. But then they're just, again, if you know how to use R, you won't this code, you'll just see one way to do it. You know, we separate data into approved and rejected. For some reason, I don't remember why, but oops, so that we can make these cross tabulations. And the nice thing, so this function right here, cross table, will create that type of table automatically for me by looking at bad loans and any other characteristic like gender. And so that's what you use when you're doing the models, and it's just easier. Here we'll look, so this is for the approved loans. Yeah, we separated them out because only approved loans have an outcome, but here's how we get that cross table that we were showing in the example. So then the function automatically presents it in this kind of view. And you know, you can copy out of the clipboard and take it into Excel if you want. It kind of works different on different computers, so it's not the perfect perfect way to do it by any means, but you can paste it in as text, or not text, but use the import wizard or something if you want to take it to R. Otherwise, sometimes it will be in print format. But these other parts of the code here I want to show you, like this is just making, so this is calculating the application, the number of, or the application share for women, share for men, and then total, and same with approval rates and share of issued loans, and then the bad rates. And it's doing all that just to be able to make the table. And that's why I was saying that this part, I think if you're not an R user, you'll see that you can get to that table. If you wanted to do this all with your, and the same for finding the cutoffs is maybe the one only other interesting thing. If you're looking for the specific cutoffs in this code, it's this is, yeah, this is an example of where I'm breaking them into the same. So I'm actually in these examples, unfortunately, maybe breaking them into the exact examples that are in the guide. Although you can make a proportionate cross tabulation that would do that, not based on the score numbers. Like this is, here I'm specifying score numbers if I want to make a table, right? This is going to be one of those like tables we showed with another thing about RStudio is that there you see the resolution. Here is where I would be breaking them into groups and seeing a cross tabulation that's in, it's for approved loans by some score buckets. And again, I think these they match up. I'm sorry if it's not like super clear like I'm presenting right now, but they'll match up. The results here and in Python all match to what you see in the Excel table. What I wanted to say was that if you, like I was mentioning, if you were to take your own data instead of this data that's here, right, in Excel, you know, you would want, again, to have 5 columns. And the main thing is when you bring data into R and you read a table in, and now, you know, the table is called data. And once I put data and I refer to it, I should see, yeah. And the $sign, so the data is the name of my table, $sign is the name of the columns. And I would have to, in the code, I would have to replace the names of whatever I put in there from the example data with the actual column names, first of all, that you use in your data, and then the actual labels, like in Excel where I was showing, if your data says men, women, you know, you'd have to update what you did in the R code so that it would say, if your data says approved in all caps and rejected, it would be okay. If it says something else, even including if your data says approved with one big letter and, you know, like small like that, you'd have to retype it because everything in scripted languages is really case specific and whatever. So anyhow, if there's any questions, I can take them on that, but let me just cut then to what, for me, I've only used Python some, mainly looking at other people's code in these Jupyter notebooks. So they're kind of cool. It's like, for those of you who know, maybe I think you use this, it's called Anaconda Navigator. but you have to install this stuff too. Sorry, I'm back to R. And then there's different libraries. So my colleague Cienko actually helped code this for me because I only know how to do a few things in Python myself without looking at you. The other thing is you can look all this up on the internet, right? I mean, once you get basically familiar with it, but you put you use in the same way you import libraries. But the key to using the data set, if you want to load up Python and try using it, and there is a Jupyter notebook in the data pack, is you do need to put the path. And here the syntax, it looks like you don't have to do anything. You just find the path like I was showing before, and you can paste it in directly to this statement where it says data path. So in the file you open, it'll say data path equals C drive /s work data misc, and you replace that with your own data path. And after that, you know, if you're using the example data file, you just use the same names and everything. And here you also can run this one block at a time. But if you don't do that, you'll also, where's this, sorry, this thing blocking me. Yeah, so you have this run button, you highlight it, you run it. It actually, because I didn't change anything, these are the results here where it says out 11, and the results are already there for the data set, so nothing would change. You know, you can see how the results would look, but if you did change things and do them, like I noticed there's a formatting error here, like you could change it, and when you rerun it, here, if I wanted it to be to 1 decimal place, I could. I'm not sure if I ran this part before. The other thing about coded languages, by the way, we'll see if this doesn't work right now, but yeah, see, so oops, no, it didn't did it reformat it? No, it didn't, but it should reformat it when I run that. I didn't start at the beginning. What I want to say is if you're using scripted languages, again, only for those of you who aren't using them, you do need to execute all the code in order most commonly, so that it still didn't do that. But so you see, you need. I'm confused by the way this looks. Like I said, I'm not normally working in Python, but you do need to execute all the code in order, so that, because mainly you're creating variables that you refer to later. So in R2, when I'm working on it, I will, if I want to start something again and make sure I don't have errors and I haven't messed something up, I'll just like take my code and run it all the way to the top, which is fine as long as your data is not very big. It's not very good if your data is big, because it could take a long time. Now let me stop talking there, and because I'm not sure what questions we have or don't have, but
I don't see any questions on R. If you have any questions, please do put them in the chat, but I don't see any.
Yeah, or just general questions. So again, the purpose, I see this, you know, is not, in some ways, probably not interesting when I'm showing it, but I'm just showing you the different tools you can use to create that analysis with your data. So that's the purpose of the data pack in the guide, is that you can use this and apply kind of that same analysis that we talk about and that we've just talked about with your own data, using any one of these tools. So
I think you've covered everything, right?
yeah, I mean, that's pretty much. So we also have, and as we discussed, we have, I know it's scheduled for longer, but barring questions from yourselves, I would like to say that I'm glad, though, too, if anyone after this at any time tries to apply this to their data, I'm actually honestly interested in seeing it too, because I've been trying to apply it to different data sets. So if you do try to use it and you have questions or you want feedback, to share the results, again, you don't need to share your data with me, but just yeah, it's interesting to see. You might find that you have parity already in the bad rates, or you don't have an opportunity. This is not saying you will, but there are many cases where you might, and so that's why it's just a relatively simple analysis to do.
There's a question if generative AI facilitates credit scoring model. I don't know that I've ever seen generative AI used for that. I guess you could try to use it to clean up data, for example, but not for to run this kind of models. I wouldn't necessarily use that. But I guess one place I would think is sometimes data is not clean. So you could use something like that to clean up data. But I don't know, Dean, if you have any idea.
Well, so interestingly, a young lady I'm mentoring in a bank right now for IFC, she uses what it's really good for, I can tell you, is that, like I was showing, you can look up how a function works in R or Python. You can just write it into Chat GPT and say, how do I do, this? And it will give you packages and everything and some examples. So it gives you some really quick answers in a more maybe powerful way than Google does. But as Maria said, for actual modeling work, I would always, and just for myself for AI, I would just always review whatever you're getting, right? Because it's not, it most likely will misunderstand the context of some stuff that I think would be the main issue. But certainly it's a good resource, I think, to get basic information.
Can you see the chat now, Dean, that you're not sharing?
Sorry? Oh, do I see it?
Do you see there's one more other questions?
Yeah.
A question on machine learning algorithms. I think Dean would generally recommend starting with a logistic regression rather than a complex algorithm, but you can respond, Dean.
Yeah, no, and for the reason being, but the main reason is that so if you do this cross-tabulation analysis, like I'm saying, here's the difference, right? So if I take all the data in any data set or in the time bank data set we have, right away, I can see the maximal predictive power I can get by putting all the data in, assuming it's cleaned and properly checked, and making an XGBoost model or any other tree model like that. And that will, depending on how I tune it and stuff, it will overfit it a little bit, but it will show me like that's the most I can get, like if no matter what I do, right? But the limitation of that and other complex methods will be my insight into where the relationships come from or what means what in the model will be kind of limited to something about feature importance. So I'll get a list that says the most important features are this, 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 and there's some bars usually that show like what's more important, but it won't tell me without separate data visualization or other analysis. It won't really tell me how is that individual characteristic that is told to be important, how is it related to repayment risk, where if I do regression or logistic regression and I make this cross tabulation, I'll be able to see visually the bad rates across a characteristic. So I'll understand that, for example, as age increases, risk goes down, or as income increases, risk goes down, or as time and employment increases, risk goes down. But mostly all these relationships tend to make sense in credit scoring models, and you risk building things into your model that you don't understand if you cut right to complex things. So, and the other thing is just that the results are counterintuitively possibly not much better. So, again, you won't get, it's not like you'll get great results using any algorithm, and then you'll get different ones using traditional scorecard building. You'll actually get close to the same model in the end. I think that the credit scoring way is a little more labor intensive nowadays, but it's because that way you have a really transparent and understandable model. And I think that can be even more important, maybe if we're talking in the context of gender too, or if you're looking at some, you'll understand like if your model has biases, if you look at things characteristic by characteristic, but if you don't, again, the risk would be, and I've seen people who are more excited than me about machine learning build models and they show them to me and they actually themselves don't understand how it works, and then we go through it, and what you'll find is sometimes you put in a piece of data there that has a unintended effect on your model, and if you haven't looked at the characteristics individually, you wouldn't know that, or I wouldn't know it too. So anyways, that's a long answer to say I would certainly try to understand your data no matter what algorithm you use, and all the algorithms should kind of lead to the same total predictive power for a credit scoring model.
Especially, and you mentioned the concept of early stage fintechs. What we were saying before is you generally, the more early stage you are, the more limited you are in terms of the sample that you have. So the more variables you try to put in, the more unstable it will be, the more likely they would overfit. So when you have a smaller sample, less variables, and a more straightforward approach are going to give you something that's probably more reliable.
Yeah.
There's a question of how to calculate the scores. I think that's kind of a whole different webinar, right? Because we're really focusing here on how to adjust a model for gender. I don't know, the codes would run and would calculate the scores, but we're not really covering in this publication all the details on how to develop a model. I can put one in the chat that we've done that kind of covers that step-by-step in model development. I don't know, Dean, if it's something that you can show quickly, but that would be a whole other kind of session on how to actually develop the model.
Yeah, I mean, I'm just trying to think. So if I can show you just a really quickly oversimplified thing of where points come from in one really simple way for one characteristic, right, for gender, which I originally had in the presentation, and we took it out because it's not, you know, essential to the way to the rest of the flow of that. But whoops, now I don't see the right thing. Okay, here I just wanted to show. I wanted to show this slide, but it's not there. So if you see this, so for each characteristic, as I was saying, you look at them individually, right? And a really oversimplified way to do it, but interestingly for me, I guess, maybe not for a lot of people, but if you took this approach, you could make a model that's almost as powerful as a machine learning model too. And that's for each characteristic. You make these cross tabulations and you look at the bad rates and you really just take, so where the points come from in traditional scorecards, but most people use logistic regression, but where the points come from is from the differences in the bad rates across groups per characteristic. So you can think of the modeling task as each variable you look at, you do what's called coarse classing, and you turn it into a group variable with anywhere between 2 and 5 groups. And those groups should have a sensible pattern in the bad rates that can be described. And kind of the difference in the bad rates gets turned into points, where the larger the difference between two groups, the more points you get in the scorecard. So if in this case, there's 10% bads for men and 5% bads for women, men would get 0 points because they have the highest bad rate, the highest risk group, and women would get 5 points because that would reflect the fact that they're 5 percentage points less risky. But if there was another feature like credit history or credit score from a bureau, for example, we could divide it into 5 groups, but the people with the highest scores might have a bad rate of 1%, and the people with the worst scores would have a bad rate of 18% or something like that. And because those would be really big differences, it would get more points in the scorecard and it would be more powerful. And if you weren't presenting it as a scorecard, but you used one of those boosting or tree models, it would be the most important feature by feature importance, but it would be that because it alone has the most ability to separate the really low risk borrowers from the high risk borrowers. So the scorecard modeling part, the real step when you build a scorecard, as Maria said, it's like, you know, beyond the scope of what we tried to cover in the guide, but the real step that I believe is important is the single variable modeling. So you just, for each characteristic, you attempt to understand the relationship of risk, and you could do an additional model like this, where you derive from the bad rates points and just add them all together, which it assumes there's no correlation, which is wrong. But interestingly, for credit data, if you do that, you also get very similar similar results to a logistic regression model that accounts for correlation. So therefore it's more accurate, but you know, the total prediction will be nearly the same. And if you use any measure of more complex models like neural networks or different things, the actual increase in prediction will also not be very much, and it might not. And some actually, if you look at papers that compare a bunch of machine learning algorithms head to head on one set of data, which is how you should compare them, by chance, some ones will perform better than others with a given data set, right? But the general overall message is just that it's really about the data, and with your data, you can kind of get the same predictive power with all the methods. And then the way you're calculating the scores is by creating these groups that order borrowers from high to low risk, and then combining each of those characteristics together in one model. So it's really like that simple. It's just you know, as Maria said, the one CGAP guide goes through more of the detail of each step, but it's just that process, and then you come up with the scores.
Yeah, so the guide I pasted would explain how that happens. Now, if you run the code that Dean just showed, it will calculate the scores for you. That it will give you that as the output. Now, if you in this publication, we don't cover the details of model development because we're focusing on how to take whatever approach you have and make it gender intentional. But the code would calculate the scores using a logistic regression, which is the most commonly used technique. But the focus of this publication was basically no matter what you're using, even if you're taking a bureau score or you're using a more complex or less complex model, you can how to add kind of this gender intentional approach. The link I put in would explain a little bit more of those steps on how they work in general. But these codes will calculate the score for you.
Yeah, but the question from Yannick, yeah, so basically that's that's what the model's for. It's for new customers and you infer the same past performance for them, but the question was, can the result of the model be inferred to new customers with the same characteristics? That's exactly what it is. You study your old clients and their characteristics in relation to repayment. When someone new comes in, the essential thing is they need to have the same set of data that the old clients provided you, but then you evaluate them based on that and you say, okay, this borrower looks like these borrowers based on a score, and you expect them to perform in that same way. And the where it breaks down though is if you're new, if you suddenly, so the other thing I didn't mention about that timeline is traditional credit scoring assumes that you're going to be lending to the same kind of borrowers. So if you suddenly want to target a totally different population of students or someone you didn't lend to before, obviously they'll have different relationships, right? So it assumes that your incoming population will be relatively similar, and actually how scorecards deteriorate over time as the population changes and the model relationships aren't as good. Becoming
more
blurry.
Changes that you introduce between when that sample was generated and now, the less reliable it would be. But again, it's about what's your alternative, right? So if you're now, say, if you only did in-person lending and now you're putting it up digitally, you're going to attract slightly different customers. So it's possible that the model predictions are not going to be as exact, but you don't have data to build a model for the digital customers. So you probably still use that model and then just over time, redevelop it with a sample that looks more like your current kind of incoming customers. The more that you've introduced big changes in how you reach out to customers, in who you're targeting, and the more that the model predictions will apply less, just because you're putting necessarily a different people through it. It would not be as good at understanding them, but it's still probably your better choice to apply it if you don't have data for the other group and just over time adjusted. Okay, I don't think I see any other new questions. I think we can end it now. I don't see any more questions coming up.
Okay.
So thank you everyone for joining. Thank you for staying this long. I know we don't normally do webinars that are this long, but we just wanted to have enough time to also walk you through how to actually apply it and show the codes. Hope this is useful, and thank you.
Thank you.